joined with Zane Jacobs of CMG Financial. And we're going to talk about some crazy creative loan programs right now that, I mean, everyone's affordability is completely shot. Like everyone's struggling right now. Home buyers out there really want to maximize the amount of home that they can qualify for. And they're getting hit with these 7% interest rates. And so as I've been talking with Zane and CMG, they have these creative options that people don't know about. So I'm excited to have him kind of on the show today. If you have any questions, feel free to post them in the chat, but don't forget to hit that like button, give us a thumbs up, let us know you're here. But let's jump right into it. We're going to talk about three creative loan programs that are going to help you save thousands of dollars or even just get a lower interest rate. We're going to talk about something called the 10-6 ARM, which is when people hear ARMs, they completely shut down. But I promise you're going to want to hear about this one. We're going to talk about the all-in-one loan, which is a loan unlike any other that's going to help people in the long run for the sophisticated buyer. And then we're going to talk about the list and lock program, which is a new program that CMG rolled out that is also going to help buyers qualify for more money. So Zane, let's jump right into it. Tell us about the 10-6 ARM. Like, what is it? Why would people want to look at it? And how can it help buyers be able to save some money on their monthly payment?
Perfect. Thanks, Brandon. I really appreciate you having me on here to talk about this. So in this market, as everybody knows, it gets kind of crazy when you get into negotiating. And most of the time people are looking at payment sensitivity, like how much is their home going to cost them each month. And so, post the crash in 2008, there's a bad name around an ARM, but the reality is an ARM is just an adjustable rate mortgage. And so what people don't really pay attention to is if you see like a 3.5, a 3.1, or a 5.7 or whatever, what that means is the first part of that statement there is how long it's locked for. So if you have a 3-year ARM, it's locked as a fixed interest rate for the first 3 years, a 5.1 ARM locked for the first 5 years in an interest rate. And it's usually a teaser interest rate, and then it'll adjust to the current market. Well, in the case of CMG, we know that the market's been volatile. So we created a product, the 10-6 ARM, where your interest rate is actually locked for 10 years, a fixed rate. And we know that every buyer and seller typically refis, buys or sells every 3 years like clockwork. So the chances of somebody staying in a loan for 10 years is less than, 97% of the market doesn't. So like it's less than 3%. So what this means is we're going to give you a 10-year fixed interest rate that's dramatically lower than the cost of a regular interest rate by typically 0.5%. So if you're looking at getting in a house now, this would get you in there on a fixed interest rate lower than current market standard. And then the cool thing with CMG too is if somebody buys a house with us this year, they're going to get a free refinance within the next 5 years if rates drop by 0.5% or more. So you can get the 10-6 ARM, get in, get a smaller payment, and you're going to be safe for the next 10 years. And as soon as interest rates come back down in the next 3 to 5 years, you're going to get a free refinance and get the market rate anyway. So great product to take advantage of right now. And we're doing that to remain competitive because it's the market is so tough.
So let me get this straight. You are saying if you're able to go with the 10-6 ARM, you get maybe 0.5% under market value, under the current interest rate. And in any time in the next 5 years, if the interest rates go down more than 0.5%, you get a free refinance.
Correct. So the cool thing about that is you're just going to be able to maximize your payment now, as well as anytime somebody would refinance. So a lot of folks don't want to pay what they call discount points to get a lower interest rate because they're like, I'm just going to have to refinance later and it's making me have to come out of pocket with more money. Well, now you get to take advantage of like that cheaper rate. And then as soon as, the time comes where you refinance anyways, it's all going to be for free. So you're not paying on the front end or the back end.
Yeah, that's huge. Wow. So I think a lot of people say, oh, that loan program sounds good, but like, how many of those are you doing? Like, is that something that people are taking advantage of right now, or that people just don't know about yet?
Yeah. So a lot of people just have a fear around ARM loans because they're like, oh, it adjusts. But like what they don't realize is there's a context to it. So an adjustable rate mortgage has more risk associated with it. So what they do is they give you a cheaper payment on the front end for a given period of time, and where the bank kind of takes a loss, and then the goal is to like recoup funds later on. But in the case of where the market is now, it's more about making less per loan and having a higher volume. So like right now, the big companies are coming up with these creative financing solutions to actually be able to maintain market share. So really the bank is taking a loss in the case of this in order to benefit the consumer. But the hope by the bank is that they can take market share and have more consumers and just remain steady while other companies are going out of business, which is happening all the time.
Right. Yeah. So if you guys are just joining us, we're looking at the 10-6 ARM, which is a great option for you right now to get maybe 0.5% under the current interest rate and be able to refinance in the next 5 years at pretty much no cost if the interest rates go down over 0.5%. So amazing program. If you guys have any questions, you can reach out to me or Zane specifically, send us a direct message or just pick up the phone. We'd love to help you with that. Now let's jump into the all-in-one loan. Now I remember when you first showed me this loan, I was like blown away at the opportunities that it creates. It's not for every single buyer out there, but this is a great loan and a great opportunity to be able to create wealth over the long term. So tell me about the all-in-one loan.
Good. Yeah. So the all-in-one loan is CMG's baby. It's an in-house portfolio product, and essentially what happens is all around the world they practice what's called offset mortgage, which is where you would take like a home equity line and do a capital injection into your principal balance, and then you wouldn't be bearing interest on the funds owed until the end of the month. And so it keeps your amortization, your interest bearing, as low as possible. So this is a practice you like a lot of people that are sophisticated in finance will do. But there's never been a commercialized product created for the everyday consumer to be able to do this. So what CMG did was they created this product in a sense where it's a first lien position home equity line of credit. So you, instead of having a loan that you could then get a HELOC on your property later, this is just one giant home equity line of credit, like a giant credit card. That's your mortgage. And it's attached to a checking account. So what happens is your income comes into the bank and it just drives down the credit line, and the odd days interest bearing will just adjust the credit line. So this does a lot for you. In the case of just the simplistic terms, essentially, instead of you making a mortgage payment every month and then no longer having access to your funds, the entire 100% of your income and money that would be sitting in the bank, not making any type of benefit for you or profit. You know, the banks don't pay you any interest. So if your money's sitting in there, it's doing nothing. In this case, it sits against your mortgage every day of the month, driving down the interest bearing on that loan, but yet it's 100% accessible at any given time. So you could, have 50 grand coming in and sitting against your mortgage. You could turn around and buy a coffee on it. So whatever you need to use it for, but while it's not being used, it's benefiting you in the case of driving down your odd days and simple mortgage interest. So it's cool too, because a traditional HELOC is tied to the LIBOR index. And in this case, it's tied to the CMT. So it's very stable. So the product is really good. And so for investors, they love it too, because they can, maybe you drive down the line very quickly. And then over time, you can use that money again to fund something for like an investment project, a short-term investment project, or maybe buy another house with it. So people love it for that reason.
Yeah. So the all-in-one loan, just to recap, is like a big HELOC, like one big HELOC. But I think when you first explained it to me, and this might be hard for some of you to follow, but in a minute, I'd love for you to talk about who would be a good candidate for the all-in-one loan. Yeah, sure. But before we go there, what I really love to see, and if you guys are want more explanation on this, we have a slideshow kind of explaining everything in a little bit more detail. But what I loved was if you're good at saving money, or if you make a consistent income, the more money that you put into that account, the more it drives that loan balance down. And I'll tell you, man, some of the scenarios that we went through and ran through, like I was blown away at the opportunity you could have to use those funds for things like, vacations, college, other investment properties, like whatever the needs are, to have that readily available and for it not to affect your everyday. So I thought that was pretty impressive. So who is the all-in-one loan for?
Right. So it's really effective for anybody that has higher than 15% post liquidity at the end of the month. So let's talk about what that means in layman's terms. If somebody made $10,000 a month and their mortgage and all other expenses combined was less than $8,500, then that would be 15% post liquidity left over. So when people have high income W-2 jobs, especially, they have income coming in, and most of the time they just end up stacking it into a savings account or retirement account. And those people, especially once it gets over 25%, it has a disparate impact on the mortgage. For example, somebody that has over 25% funds left over at the end of the month will typically pay their house off in 6 years. So people use this because you wouldn't traditionally make 2, 3, 4 extra payments a year on a mortgage, because once you send that money down, it's gone. Well, in this case, when that high income W-2 earner is just letting funds sit against their account, it's always readily available for them, but it drives it off real quick. And so there are some stipulations here. You do need to have at least 10% of down when you take a loan like this, and you still need to have 10% left in the bank just as reserves. And you also have to have over a 710 FICO. So if it's a strong W-2 income, has really good credit, like this financing tool is amazing. It actually has its own website. So there's a division inside of CMG that runs this program. You can look it up, www.allinOneLoan.com, and that will give you the whole breakout. There's income savings calculators, tutorials that explains the whole thing. But that's our baby as a product, and it actually has its own division. So it's really cool.
Love it. Love it. Yeah. So you can go check out www.allinOneLoan.com for more information. And let's hit the list and lock. This one I think is super creative based on where we're at currently in the market. We have low inventory, right? All over the place. We have affordability is tough for buyers right now. So I think CMG came up with something creative called the List and Lock program. Tell us more about that.
Okay, perfect. So people are starting to hear terms like a 3-2-1 buy down or a 2-1 buy down, where essentially a seller will give you credit towards a buyer's interest rate to buy it down for the first couple of years, or maybe 3 years or 2 years, and then after a couple of years it will go to market rate. Well, in this case, what people don't really understand is you can lock a rate against a specific property address. So typically when somebody gets pre-approved, they don't lock a rate because they're waiting until they find a house to lock. It's called a subject property to lock the rate against. Well, in this case, we came up with this tool where we could lock a rate against a property that a seller has, and then anybody that buys that property will get that interest rate. So the cool thing about this is they would take a seller concession of 3% and apply it to that rate. So it's a below market rate. And then the lender, us, will go ahead and match that with another 3% lender credit, so it doesn't violate any RESPA laws, and it drives the interest rate down extremely low. And then us as a loan officer, we also take a cut on the commission. So it's a 6 to 7 points under the market rate value that somebody can get. So what that means is a bunch of things. For folks that have that are shopping in areas with low inventory, this gives an incentive for buyers to be able to get in and get a rate that's going to make them qualify for a bunch more. So in the case we just had one last month, a buyer was pre-approved for $425,000. There's a property listed for $500,000. Well, the difference in the rate that we had locked on the list and lock actually bumped up the pre-approval for the buyer coming in from $425 to $500. So what they weren't able to afford then, they were now able to afford, because there's about 7 points in actual buy down that was given to them for free. So that's really cool. So for properties that are like not moving very quickly, or for somebody that's got like an off market deal, or if somebody, has a relative they want to buy their house from, these programs work extremely well.
Right. And so I think about the houses that are overpriced, that you may be able to, instead of doing a huge price reduction, you may be able to look at something like this list and lock, and it could be a good opportunity to get buyers in there that, they can qualify for a little more. So
yeah, that's great, Brandon. Let me add to that, because say, for example, you just went in to buy a house and you're like, hey, we're going to ask for a 3% seller concession, and that might help you get the house. But here's the deal. Like, you don't automatically get a 3% lender concession plus an LO concession on top of it. So in this program, you could say the house was overpriced and you're like, hey, we're asking for this credit, but it's also going to help us qualify for more, because the lender and the loan team is going to kick in on it. That is guaranteed for you. And so it's a guaranteed sell. So that's really cool.
Yeah. I love it. Hey, all of these, I know it's a lot of information we just hit you with, guys, But right now in this market, it's more important than ever to look at other options other than you're always going to have the CalHFA down payment assistance programs. You're always going to have those, but we're looking at creative options because there are so many loan options out there, and you got to figure out the one that's right for you. So should you have any questions, hit up Zane Jacobs. We'll have his information down below. Hit up Zane Jacobs, and he can help you see what loan program might work for you. And as always, Brandon Leone here, your Sacramento area realtor, helping you buy and sell real estate. Thank you so much for joining me, Zane. And we will do some more, I'd say more detailed videos here soon on these programs to get you more information. As always, we'd love to hear from you, hear what you'd like to hear about every single week as we go live Wednesdays at 1. But we will see you next week. Take care.
Appreciate you guys. Thanks for having me.